The top business stories live from the Sky News City studio. Tesla announces plans to accelerate the release of new models as its revenues hit reverse. Ryanair to create 1,000 more jobs in the UK as it forecasts its British traffic will grow by more than 20% by 2030.
Most people don't appreciate the size and scale of our investment in the UK. We think we're now one of the biggest, if not the biggest, one of the biggest overseas investors in the UK.
Plus, Lloyds banking group sees profits fall during the first 3 months of the year. Good morning, this is Business Live with me, Ian King. Tesla last night reported its worst start to a year since 2021. The electric vehicle maker, which last week said it was laying off more than 10% of its global workforce, reported sales of $21.3 billion for the first 3 months of the year. That was down 9% on the same period last year. Meanwhile, its net profits fell by 55% to $1.3 billion. But the shares rose after hours after the chief executive, Elon Musk, announced plans to accelerate the launch of new models with an emphasis on affordable vehicles. Well, joining me now is a great friend of the programme, Daniel Ives. He's Managing Director and Senior Equity Analyst at Wedbush Securities. Dan, good to see you this morning. Thanks for joining me at such an unsociable hour. Reuters recently reported that the Model 2 was going to be cancelled, yet it appears affordable vehicles are going to come after all.
Yeah, look, it's somewhere in between. We'll call it almost a Model 2.5, but the lower cost vehicle is coming. It's actually accelerated ahead of plan. That's music to the ears of the bulls. I mean, this was the biggest fear going into this conference call. The street needed an adult in the room, and Musk finally became that adult in the room.
I thought it was interesting, Dan. I mean, we've previously been told that new affordable vehicles were going to need brand new manufacturing and production facilities. That no longer appears to be the case.
Yeah, Ian, that's the key, because they're going to be able to get this out pretty quick. I'll call it a 25 to 30K vehicle, over the next 12 months. And look, they're going through a demand storm. This is a Category 5 storm that Tesla's navigating right now. They need to get onto the other side of this. That growth story is still there, but that's why right now you need Musk to be the power on the plane. This is what the street want to see. Clearly, autonomy is on the other side of that.
Strategically speaking, Dan, is Tesla right to go into affordable vehicles?
I don't think they have a choice, because you see the demand story, not just in China, Europe and US, need cheaper vehicles. But they have the ability now to produce those vehicles and profitable at cheaper prices. And that's essentially what they're doing here. But call it the next 3 to 5 years, autonomy, you could say, is really the golden vision. But in the near term, it's all about volume. Now the volume story is back on. I'd expect investors to look at Tesla a lot differently today than they did fearing it 24 hours ago.
Yeah, you mentioned autonomous vehicles there, Dan. We did get an update last night on the so-called robo-taxi. What caught your eye there?
Look, I think they're making significant improvements. Look, there's obviously a lot of regulatory that they need to get through, but they will ultimately, the drum roll will be August 8th. That's where they're going to unveil the robo-taxi concept as well as some of the prototypes. And this is the longer term story. I mean, on autonomous, I could argue that that's $1 trillion of value right there. So it shows that right now, Musk is navigating on both sides. The autonomous vision, but the demand story in the near term, that's been the dark storm cloud that he needs to navigate through.
Now, Dan, it looked like with the results themselves, the street largely looked through those. But do you worry that they're not going to be able to raise deliveries this year?
Look, it's a worry. There's pressure on Musk. I'd say after a Cinderella story, the last 3 to 4 years, it's been a bit of a horror show in the near term. So this is a fork in the road. I believe he can navigate through it, show growth from a delivery perspective, but it's all about volume. And that's why execution needs to be flawless over the next 6 to 12 months. And then I think that golden story returns back to that Tesla symbol.
All right, Dan, we've got to leave it there. Thanks again for joining me so early in the morning. We do appreciate it. Now, while the hospitality sector continues to grapple with higher costs, staff shortages and a challenging backdrop for consumer spending, a new investment vehicle has just raised £50 million with a view to becoming one of the UK's leading premium and high-end operators. It's called Hestia Hospitality, and its backers include the former Sainsbury's chief executive, Justin King. Well, I'm very pleased to say Justin joins me now, along with Andrew Fisher, who's the chief executive. Gents, welcome to you both. Andrew, let me start with you. What gave you the idea?
Oh, the idea was really born out of the fact that there was a bit of white space in this industry. I was being asked a lot by friends, restaurateurs, chefs within the industry to look at how there might be a consolidation play within the premium dining sector, which had always been slightly unloved, considering the amount of investment that had gone into the casual dining sector and the quick service restaurant sector. So the idea was the back of the envelope idea was that simple. It was, how can we consolidate? How can we invest in that bit of the sector that had traditionally seen a load of silo operators operating, and it had been untouched in terms of a larger investment strategy.
What do you like about the idea, Justin? What made you come on board?
Well, Andrew, first and foremost, in fact, it's an idea sort of long in the making. I actually first met him long before COVID, 5 years or so ago, and he gave me that spiel. He showed me the back of the envelope. I liked the idea and told him I'd help him if I could. Made a small investment at that time. And I must admit, for a good bit of the last 5 years, I didn't think he was going to get it off the ground. But things have accelerated in the last 6 months or so, which has allowed him to make the announcement that we have in the last week or so of raising the fund and getting going at last.
Yeah, I mean, it's no easy feat raising money in this environment.
No, it never is. And I think hospitality has always been one of those industries whereby if you go into an investment meeting, you're first having to come up against why hospitality, rather than just why ours or why this idea, as you would in any other sector. So there's always that barrier. There's always that barrier to overcome of why hospitality. And I think, often the hospitality industry gets talked down as a sector, as a realistic grown-up sector, of which, of course, it is. So, yeah, it's never easy. We took a couple of paths. We looked at doing this as a PLC, as an IPO originally, and there was no opportunity to bring it to market at this point, so we ended up doing it privately. But yes, it's never easy.
That's a good point. I mean, the restaurant sector in the PLC world has been somewhat unloved in the past, hasn't it? And a lot of casualties.
Yeah, and when the idea was first presented, it was very much a public company idea. That's, I guess, partly why Andrew knocked on my door with my public company background. It became private because it became clear, whether COVID played its part, I suppose it did, that private was the route. And what it's allowed Andrew to do is to show investors specific investments that they can get excited about. You can almost feel and touch them, so to speak. In fact, they can rock up and dine in them. And I think that's made it easier to persuade people that, whilst you may have a generally view of hospitality that it's troubling, if you can see the specific investment and its potential, then you can still write the cheque. And he's done fabulously well. I mean, I think it's a great thing that Andrew's doing.
Yeah, now you're targeting the premium end. You've already announced your first couple of investments. Why have you gone for that end of the market? Is it because the margins are better?
Yeah, I mean, absolutely. It's a few things. I think we've seen that area of the market incredibly resilient after COVID. People's desire to come out and break bread with other people has gone up, and it's been the average spend per head, the table bookings has been incredibly resilient. That end of the market is also easier to weather things like cost of goods, energy prices, those kind of things are easier to weather in that end of the market. But for me, the main bit, the most exciting piece, as Justin rightfully said, is that it's relatively untouched. Everyone's a little bit scared of that end of the market. They think they can do quick service quite easily. They think they can do casual quite easily. My bit of the market and where I add value, if indeed I do on a good day, it's always been around that bit of the premium sector. And I think what we're seeing is that because it's relatively virgin territory, it's exciting for investors to get involved. As Justin said, it's an easy investment to understand. They can touch it and eat it.
Yeah, now, Justin, you've got bags of experience in the consumer sector. What do you make of all the numbers we're seeing just now? I mean, look, we've had 2 tax cuts since the beginning of the year. Interest rates feel like they're going to come down. There should be a spring in the step of consumers, but it doesn't seem to be happening. Why not?
Well, I think, as in everything, the downside was probably overstated, and therefore the expectation of an upside is always going to be perhaps overstated in the other direction. The cost of living crisis was visited upon a very particular part of our economy, our fellow citizens. If you were hit hard by food and energy costs because it's a very high part of your weekly expenditure. It was a massive crisis. But for those that are wealthier in our society, those are relatively small parts of the weekly spend. And that's why this sector actually has been so much more resilient, I think. So I think in a way it's kind of forced to expect a big bounce because for many there was never really a trough beforehand. And, you know, if you've tried to book in a top-end restaurant anywhere in any of our major cities in this country for the last couple of years, you'll know that that sector actually has been quite buoyant. It's hard to get a table.
Yeah, very good point. We've got to leave it there, I'm afraid. Justin, great to see you again. Andrew, good to see you too. Best of luck with it all.
Thank you.
Thank you.
Some other business news stories for you now. And Ryanair has just announced plans to grow its UK traffic from the current 53 million passengers a year to 65 million passengers a year by the end of the decade. Europe's biggest airline said that in time it aimed to create more than 1,000 new jobs in the UK, including pilots, cabin crew and engineers across 22 airports. Well, the news comes a day after Ryanair launched a lawsuit against NATS, the UK's National Air Traffic Control Service, over the network-wide failure last August, which saw thousands of flights grounded. Ryanair also unveiled an independent report from York Aviation, suggesting it contributes £14 billion annually in gross value added to the UK economy and supports 98,000 UK jobs.
Everybody knows Ryanair, everybody's heard of Ryanair, but most people don't appreciate the size and scale of our investment in the UK. We think we're now one of the biggest, if not the biggest, one of the biggest overseas investors in the UK. We've 115 aircraft based here across over 20 UK airports. That's an investment of over $10 billion inwards in the UK economy, and we're supporting about 98,000 jobs across over 20 UK airports.
And you can watch my full interview with Michael O'Leary from Ryanair on our afternoon edition at 4:30. Do join us for that. Lloyds Banking Group has suffered a drop in profits during the first 3 months of the year following a fall in the spread between what it charges borrowers and what it pays savers. Pre-tax profits came in at £1.63 billion. That was down 28% on the first 3 months of last year. The UK's biggest provider of mortgages and current accounts also cited a rise in costs due partly to a new Bank of England levy on the entire sector. Lloyds set aside £57 million against loans it does not now expect to be repaid in full during the quarter. That was down from a write-off or impairment of £243 million in the same period last year. I can tell you the shares are currently ahead by some 2.25%. The healthcare products and household goods giant Reckitt said this morning it's benefited from customers trading up to premium products during the first 3 months of the year. The company behind brands such as Dettol, Cillit, Bang, Nurofen and Durex said it enabled it to raise sales by 1.5% on a like-for-like basis during the period, all of which came from price rises. It cited strong sales growth in particular for household goods brands Finish, Lysol, Harpic and Vanish, as well as for Durex. The shares are currently ahead by 3.75%. And another consumer goods company, this one the business behind Imperial Leather Soap, said today it's considering options for its Africa business. PZ Cussons said that although it owned a highly attractive group of assets in the continent, it recognised that this was a complex business and was therefore evaluating its strategic options, both to reduce risk and maximise shareholder value. The Manchester-based company is also putting up for sale its Saint-Tropez self-tanning brand, which is favoured by personalities such as Kim Kardashian, after concluding it did not have the resources to realise its potential across the United States and elsewhere. The shares are up some 6.5% just now. Well, last night's gains on Wall Street were followed by a largely positive session for stocks in the Asia-Pacific region overnight. The Nikkei 225 in Tokyo finished above 38,000 for the first time in a week. Well, in Europe, here's how stocks are trading right now. Only the IBEX in Madrid in negative territory. Very busy day for company news. So one of the major talking points is Kering, the European luxury goods group behind Gucci, off 8% in Paris following a profits warning. Elsewhere in Europe, Heineken is ahead 1% in Amsterdam after a steady as-she-goes trading update. Well, here in London, the FTSE 100 has in the last half hour hit another intraday record high. Here's the current picture. FTSE nearly half of 1% to the good. One or two of the mining heavyweights laying a hand this morning after a couple of days of weakness. In percentage terms, well, Reckitt's the leading blue chip gainer, but Lloyds Banking Group, as you can see there, currently some 2% to the good on its results. To the downside, well, that caring update has sent Burberry lower by nearly 2.75%. Outside the FTSE, the asset manager Aberdeen is up 1.75% after it returned to reporting net inflows, but the polymer specialist Victrex is slightly lower on adverse broker comment. On the foreign exchange markets, well, the main talking point continues to be the weakness in the Japanese yen. In terms of the main currency pairs between sterling, dollar and euro, all of them largely unchanged just now. Meanwhile, on the commodity markets, after a modest rally yesterday, the oil price is drifting again today. A barrel of Brent crude will currently set you back some $88.07 a barrel. That's off nearly 0.2% on the session. Joining me this morning is Lindsay James, investment strategist at the wealth manager Quilter. Lindsay, good to see you this morning. Let's start with Lloyds. Not a fantastic set of numbers, but the share price is higher today.
That's right. I think investors had been a little bit nervous about these results ahead of time. First of all, we look at the backdrop. We've got high interest rates, and so borrowers are just that bit more reticent to try and take loans out at the moment. Added to that, we're expecting to see interest rates starting to come down. In an environment like that, you tend to see banks having lower net interest margins. That's the difference between what they're able to charge borrowers and what they pay to savers. So the outlook for banks has got these headwinds at the moment. But I think there was a little bit of a relief that at Lloyds, where they have, of course, got rid of some of their risk staff in recent months, we only saw impairment charges there of 57 million. That's around, well, considerably lower than the 250 million that analysts were expecting. So it looks like those risk controls have been pretty good in recent months.
Yeah, and the slide in net interest margin, I mean, we've heard this from all the big US lenders over the last couple of weeks, so I guess it shouldn't be that much of a surprise.
Well, that's exactly it. And actually, they're guiding to a full-year net interest margin of 2.9%. It's only a tiny bit lower than the figure they announced for Q1, so they're anticipating being able to hold on to some of that profit. It's a challenging backdrop, though, of course, from those new banks coming on, competing for that mortgage business. So they've certainly got their work cut out for the year ahead to deliver that.
Yeah, well-run business, though, isn't it?
Quite.
And what about Reckitt? I mean, this has been one of the markets walking wounded for quite a while now. They've really surprised on the upside this morning.
That's right. Some very good financial statements out from them. We've got positive like-for-like growth of 1.5%. And here I think the surprise is that volumes are only down 0.5%. The market was expecting volumes to be down over 3%, really because of this ongoing cost of living impact. We were expecting to see people continuing to trade down, but actually that's happening at a slower pace now. So good news for the premium brands that they have at Reckitt. But overhanging the shares is, of course, this litigation issue. Now, in recent months, they had to pay $60 million out over their brand Enfamil in the US, a nutrition business. And we're going to have to wait until September as they challenge this payment, they challenge this ruling. But the market's kind of penciling in a worst-case scenario for this at the moment. We're going to have to wait and see how that pans out.
Yeah, it was notable. They didn't say very much on that this morning, did they?
Nothing whatsoever, to be honest. But they're very confident when you talk to them that they'll be able to turn it over. So, you know, I think the market is taking a little bit of confidence from just how robust the management have been on that. But, you know, they have penciled in significant costs ahead into that share price. So we'll have to wait and see if that, you know, actually comes to pass.
More broadly, Lindsay, here we are, third day running of intra-high gains for the FTSE. What are your reflections on it all?
Well, I think when we look back at the year to date, really it's been a little bit of a rerun of the fourth quarter last year. We got pretty good growth coming through globally. We've seen that leadership of the Magnificent Seven starting to narrow a little bit. It's been just reliant on a handful of names. And so I think investors are willing to look elsewhere for more diversification in their portfolios at this point in time. I think the UK market has benefited a little bit from that. But as that shift of value, that defensive angle in recent weeks has come back to the fore. We've seen oil prices that little bit higher and perhaps a little bit more optimism about the UK economy, but it's really at the margins. So I think, you know, the FTSE 100 is still going to have issues for the year ahead, given its narrow focus on sectors relative to perhaps some of the more international markets with more diversification.
OK, well, thanks for bringing us all down to earth, Lindsay. Good to see you this morning. Thank you. And if you scan the QR code on your screen now, you can read my online analysis of why the FTSE has hit a record closing high 2 days running. Do have a look at that if you can. Scan that QR code right now. Well, still to come here on Business Live, why the amount of companies buying back their shares has fallen sharply. Stay with us.
I'm Martha Kellner and I'm Sky's US correspondent based here in Los Angeles.
It's turning everybody into, a crazy, violent drug addict.
How are you feeling?
I am angry. Legal abortion!
It is an anti-woman agenda.
2 women say that you paid for their abortions. Are you a hypocrite, sir? Will your candidates win?
I hope so. I think they will. I think they're great candidates.
I gotta be realistic. My sister's dead.
More than 4 weeks on, there's no murder weapon and no suspect. Are you going to catch this killer?
We are doing everything we can.
Ghislaine Maxwell has pleaded not guilty to all 6 charges against her. Mum, how are you feeling today?
Jeffrey said, you answer to Ghislaine, you just don't cross her.
We're so excited.
Severe nightmares of these people coming in and just taking me in the middle of the night.
I've watched as whole towns were torn apart by natural disaster.
I'm alive and I'm thankful for that, but there are a lot of people who aren't.
It's not the winds people fear most here, it's the water. We take you to the heart of the stories which shape our world. Do you truly believe what you're saying?
A lot of cases that I know are reported from Ukrainian missiles themselves.
Ambassador, with respect, I think that's preposterous.
You want to talk business? Meet me in the On-Board Lounge. Fly Emirates, fly better.
Welcome back. It seems that barely a day goes by at present without one company or another announcing a major share buyback programme. So it was surprising to learn today that during 2023, the amount of money being spent by companies on buying back their shares fell sharply. Research published today by the fund manager Janice Henderson reveals that the value of global share buybacks fell to $1.1 trillion last year. That was down 14% on 2022 and came despite big share buybacks from household names such as Microsoft, Apple, Shell, HSBC and Barclays. Joining me now is Ben Lofthouse, Head of Global Equity Income at Janice Henderson. Ben, good to see you this morning. Just for the uninitiated, why do companies buy back their shares?
Well, it's a way of returning capital to investors. So as an investor, even if you run your own business, you put your money in, and at some point you need to get some money out, whether it's dividends, whether it's buybacks, or whether it's in share appreciation, you need to sell the shares. So there's an increasing demand from investors for companies to buy back shares if they don't have stuff to do with the excess cash. Yeah, and buybacks are a more tax-efficient way of doing it than dividends quite often. Yeah, they can be, depending on the jurisdiction. They also help, if there aren't any shares issued, you shrink the amount of capital, so there's more profit for everyone who's still a shareholder, if you do it year after year after year.
Yeah, good for earnings per share. I mean, I was really surprised that the value of buybacks fell last year. Why was that?
Yeah, we were really surprised as well. I think we published it when we started to do the work on it. We thought, this is going to be another big year. The big changes are within technology, and one way of looking at it is saying in 2022, technology stocks fell a lot when interest rates went up, and companies saw the opportunity to buy a bargain. The other thing that slightly affects things are things like acquisitions. So people like Microsoft buying Activision, people like Oracle buying Cerner. They're quite big deals, and so maybe you stop your buyback for a bit and you spend some of that on a deal. So this should be taken as an encouraging sign in some ways. Then companies are finding other things to do with their capital other than just buying back their shares. Yes, I think it is. I think the other thing I think that's interesting is it shows that it's like a release valve, the buyback. So, it's the dividend is something that you try and pay come hell nor high water, but actually the buyback, maybe you vary over time depending on how much spare cash you've got in your pocket. Yeah, I mean, worth noting though, outside the US, UK companies were doing more buybacks than more or less anyone. It's the second biggest market actually for buybacks in our study, which is interesting because people often say, the UK is a very cheap market. When will it make it? When will it not be cheap? And companies are trying to do something about that, and it is big oil and bank companies that are leading the charge. Yeah, I mean, I've lost count of the number of CEOs who've groused to me over the last 12 months about valuations. I mean, this is a sign though that these CEOs think their stock is cheap. It is. And I think it's also the reason that we do these studies is because we all talk every day about what the FTSE does intraday, but actually what you actually get out of cash from the companies is not really reported. And it's a bit of a surprise to see how much cash these big companies are generating. And replicating that is difficult. So their value versus private market assets is significantly lower when we see people doing takeouts. And it's partly because this cash generation is very strong. Yeah, good. It's time. Now, well, interesting to note that in Europe, buybacks were up last year. Yes. Europe and the Far East historically have been regions that do less buybacks. And we've seen it picking up over the last few years. I think that's partially just frustration with the low valuations of their shares, to be honest. What do you expect to see briefly this year? I would expect to see buybacks continuing. I think these big companies are relatively unaffected by interest rates. Banks, benefit from higher interest rates. I think if you go down into the smaller companies, you have seen buybacks stop and more debt being repaid. So I think it's very much a large cap, small cap kind of split. OK, Ben, good to see you this morning. I'll leave it there, I'm afraid. Thank you. That's it from me for the time being. I'll be back, of course, at 4:30 with that interview with Michael O'Leary from Ryanair. Do try and join me for that if you possibly can. Well, coming up next, it's Prime Minister's Questions. It's the deputies today, Oliver Dowden and Angela Rayner. And talking you through that will be Jane Secker and Sam Coates, our Deputy Political Editor. Don't go anywhere. See you later. Cheerio.